Hello, I'm Zoe Brunson, Chief Investment Strategist at AssetMark. As we move into the second half of the year, our focus is not on saying we know exactly where rates are, inflation, or markets go from here. It's about stepping back, looking at the portfolio as a whole, and asking a very practical question. Is this portfolio resilient for the environment ahead? Unless you've been on a desert island, there's no escaping the news about the upcoming midterms. Historically, midterm elections have been associated with higher volatility, which shouldn't be surprising. Markets don't like uncertainty, and elections tend to create plenty of it. We shouldn't be trying to trade the election, but rather that volatility can create a rebalancing window. The message is simple. Volatility is not a surprise. It is part of the plan, and when markets move around, it creates an opportunity to rebalance, revisit risk, and make sure the portfolio still lines up with its goals. One of the key data points today is just how concentrated the market has become following the success of the Mag 7. And it's not just in the US, but also in emerging markets as a knock-on effect of AI growth. Nvidia alone is now larger than the combination of 3 entire market sectors. That is a remarkable statistic. But the real broader point is, owning the index does not always mean being as diversified as you may think. A market cap weighted portfolio today can be heavily dependent on a narrow group of companies and themes. That doesn't mean we abandon large cap growth or the companies that have worked. Many of them are still strong businesses. But it does mean we need to be intentional about position sizing, sector exposure, and style diversification. Cash has felt comfortable because yields have been higher, and we've seen money market assets balloon to $7.8 trillion. But comfort is not the same as strategy. The question to ask is, what job should this capital be doing? In many portfolios, bonds deserve another look. With yields reset higher, fixed income has a better starting point than it had when rates were near zero, and a yield of almost 5% is indicative of a subsequent returns for bonds. In addition, when looking at 1 and 3 year average annualized returns of cash versus non-traditional and multi-sector bond funds, on average, cash is trailed by 2 to 3%. Add to that lower interest rate sensitivity, and bonds can again play a more meaningful role in a portfolio. Bonds today are generating income, providing return potential, and helping diversify equity risk. The opportunity is to move from idle cash to intentional and actively managed fixed income exposure where appropriate to provide ballast to the portfolio. Alternatives should not be added just to make a portfolio more complex. They should solve a problem and serve a role. In this environment, diversified alternatives can potentially complement the bond allocation and help improve risk management, especially if traditional stock-bond relationships are less reliable than clients expect. Over the past 3 years, broadly diversified alternatives returned over 9%. Not only is that a stronger return than 10 years ago, but they're also outperforming actively managed bond funds by 2 to 3%. The key to alternative exposure is purpose and diversifying risk management. We want every allocation to have a reason for being in the portfolio. So that brings us to the portfolio construction framework. When we say elevating portfolio resilience, we're talking really about building a portfolio for different outcomes, given election volatility, stickier inflation, AI-led growth, and geopolitical shocks. Focus on building a portfolio that has a strong multi-asset core and intentionally add to it more equities, bonds, and alternatives that can further elevate diversification, provide ballast, and be tailored to client goals. Looking at broadening equity exposure, we start with a core 60-40 portfolio that often has a US bias and a growth tilt. That has been helpful in recent years, but it can also create unintended risk. To broaden equity exposure, it could mean adding quality-focused global equity, dividend strategies, value exposure, lower beta equity, or tactical risk-managed strategies. We're not trying to make the equity exposure more complicated. We're intentionally positioning it to make it more durable across a wider range of market environments. Here we show some examples of strategies on the AssetMark platform that can help broaden equity exposure. In fixed income, active management matters in today's environment. A core portfolio may already have broad bond exposure, but the bond sleeve should not be treated as an afterthought. Active managers can manage duration, move across sectors, and access extended credit opportunities where appropriate. With yields higher, fixed income has a more important role to play, but implementation matters. We want the bond allocation to be intentional, providing ballast to the portfolio and not be just a placeholder. On the AssetMark platform, we have options for investors seeking return, income, or lower sensitivity to interest rates. Then we have alternatives. For many investors, alternatives can help complement bonds as part of the risk management sleeve. This is not about adding complexity for its own sake. It's about asking, what problem are we solving? If the goal is to improve diversification, reduce reliance on traditional stock and bond exposures, or help smooth the ride, alternatives may have a role to play. There are 3 key strategies that provide diversified exposure available on the AssetMark platform. When we bring it all together, the framework is straightforward. Multi-asset strategies help keep the portfolio driving towards investor goals, providing exposure to economic and market cycles. Equities are there for long-term growth. Bonds are there for income and ballast. Alternatives can provide additional diversification, and cash provides liquidity. None of these exposures should be accidental. Each part of the portfolio should have a clearly defined role. Here, we showed 2 sample portfolios. The model-based portfolio consists of ETFs and mutual funds, while the SMA-based portfolio consists mainly of individual securities and subsequently requires a higher level investment. I want to close with 4 actions to consider as we go into the second half of the year. First, diagnose. Look for concentration by stock, sector, style, geography, manager, or asset class. 2, rebalance. If parts of the portfolio have run, bring risk back in line with a plan. 3, upgrade. Use quality income and diversification to make the portfolio more resilient. And 4th, communicate. We shouldn't be trying to predict every turn in the market. We need to make sure portfolios are built thoughtfully and positioned to absorb several plausible outcomes. The bottom line is, quarter end is a natural moment to move from reaction to construction. We cannot control volatility, elections, interest rates, or market concentration, but we can control how portfolios are built and elevate their resilience. And just remember, not taking action is a decision, especially if you've already worked on putting together a diversified and resilient portfolio with your advisor. Thank you for listening, and if you have any questions, please reach out to your financial advisor.